I tell my whole journey, losing it all, and in my first real estate deal, making it through high tech, and my single families, and then apartments, and energy, and oil and gas, and lesser known alts. And I tell my whole journey, and hopefully, if it inspires some other people along their journey, then it's enough for me.
Welcome to Alt Investing Made Easy, where we explore the complex world of alternative assets. I'm Roland, a securities attorney, investment advisor, and your co-host.
And I'm Sarah, an investment advisor and corporate attorney, and your other co-host. We'll guide you through real estate, private equity, and more, making complex topics accessible.
Tune in for insights that empower your financial journey.
Let's make alt investing easy, one episode at a time.
Welcome, everyone, to Alt Investing Made Easy. Today, we have a special guest with us, Mr. Patrick Grimes. He's here to talk to us about several funds that he's involved with through his Passive Investing Mastery program. And welcome, Patrick.
Yeah, glad to be here. I was excited when I heard about your platform and looking forward to this conversation today.
Thank you, Roland. Do you want to?
Well, welcome, Patrick, and checking out your website. I think that there's some real overlap between what we're focused on and what Alt Investing Made Easy is focusing on, and then for you, for Passive Investing Mastery as well. I'm really impressed by what you have and the way that you're positioning things. It's very clear the layout of the fund, but. Patrick, we always like to start finding out a little bit about who you are as a person, and you can go back really as far as you want. We try to target the length of these to be about 40 minutes. So if we're going to spend a lot of time on your childhood and things like that, then we maybe won't have as much time to talk about the funds. But we really do like to get to know the people that we talk with, and how did you wind up where you're at today here?
Well, my parents were hardworking professionals, like probably many of your listeners. I didn't come from wealth of any kind, education, and my dad was a pastor. And, I kind of made my ways, born and raised up in the mountains, up north side of Yosemite National Park. I kind of had an affinity for engineering. That's what led me into mechanical machine design and automation and robotics. And that was my career, right? That was my path until I die. And, that was all wrecked when I started doing well. And I talked to the co-founder of the company I worked for, and he asked him, hey, where should I invest? Right? Where should I put some of these bonuses I'm getting? And he said, he didn't say, go put it in this stock portfolio or this startup. He said, go dump it in real estate. And his only regret was not doing more sooner. And that's how I got started down the alternative investing journey.
That's it's kind of, I don't want to say a common story, but I think it's one of those things where a lot of people we talk to are like, I wish I'd learned about this earlier. And that's one reason we're passionate about creating this platform and trying to talk about all these things, is we want to try and reach more and more younger people who are in university. There's no reason. You can start with your, I guess you could say, passive investing, or with your alternative investing path at any time. So, well, Patrick, you really, it's been so enjoyable to talk to you, and we kind of started the conversation before we started recording. So let's go back and just touch on, do you have these different products, and you have them for a reason, and it's a really relevant reason in the economy as it is at kind of this moment, which is mid-May 2025, because we're going through some upheaval, one might say, or there's a lot of up and downs as to what is happening and what might happen. So what would you say about that, and especially relative to what you have to offer?
Well, so I actually went through 2009 and 10 in my first real estate investment, and I lost everything because I was in a highly speculative, risky pre-development. And so during those times, I learned about alternative investments that are non-correlated to each other, that don't ride the same waves, they're not hinging on interest rates or the stock market or oil and gas or gold. And we find ourselves in a similar situation today, where this is actually in commercial real estate. We're seeing a collapse post-COVID here, similar to that we saw in residential real estate. It's the biggest hit of my lifetime. And so you're seeing a lot of people maybe got really over-indexed in apartment buildings and other kinds of commercial real estate hit by a number of very crippling factors, not just interest rates, which is what everybody seems to focus on, but we saw an eviction moratorium happen where for the first time you couldn't charge rents. And then there was a backlog after that, after the rental assistance ended, which crippled operating reserves. And then after that, materials and payroll inflated, costs went up, and then insurance premiums went up, like talking 20, 30 or double and triple in some markets, especially in some of the more typically favorable ones. So really, this is a perfect storm. So in commercial real estate, you're seeing a lot of trouble. And with the rise in interest rates, and 11 out of the last 14 Fed rate hikes ended in a bust. And the engineer in me is like, oh, man, what kind of safety factors, what kind of safety margins do I have in my portfolio? You know, because I've seen how I can go for a ride if I'm over-indexed in one. Now, did they also have a trade war going on at the same time in those past situations that we see ourselves in now? And do they have the world's biggest economies betting against the dollar as well? And was the government spending spiraling out of control like it was? I mean, there is a whole tornado of factors that make me want to make sure I'm allocated into investments which can ride out downturns, or at least allocated into various kinds of investments which are influenced by different market fundamentals. So I have the best chance of capital preservation and returns during an upheaval period.
Yeah.
Yeah, that's one thing that I think, you know, we just talked with one of our other law firm clients, Rohit Sood, sorry, and he has a long only private fund, but you know, can't really call it a hedge fund because he doesn't have hedging strategies, but it's that capital preservation and absolute return model. I think that is so important to emphasize that when you have the downturn or drawdowns in your portfolio, when you look at the math behind what the returns you have to achieve in subsequent years just to get back to zero, it's so important to understand why, you know, maybe having this strategy, you know, thinking more about capital preservation rather than just, you know, what's the average return. I mean, I really like that you emphasize that, Patrick.
Well, they say if you lose, you know, half of your money in a deal, it takes 100% return to get back to break even. If you lose all of it, it's an infinite return to get back to break even.
Yeah. Yeah. So let's, you know, so as we were talking about earlier, then your take is what was the term you're saying? Not recession proof, but recession
Resilient.
Recession resilient.
Right. Because yeah, exactly.
No, I love that term because I think resilience is something that, you know, arguably is in every part of one's life. So naturally you need it in your financial life as well. And so when you say recession resilience, how does that translate into, say, how you do actually invest, or what you tell people about investing?
Well, so any watch that has a certain resistance, water resistance, or, you know, waterproof, it has a little rating on it saying to a certain meter, right down below the surface. And so you want to take a lot of some like the more speculative investments that I was involved in. They really hoped that the market stayed above water, and they really hoped that you didn't go too far underwater, or else that watch would crack, right? And that investment would crack. And so you got to take a look at that resilience or that resistance. What if these downside scenarios play out like we've seen in past downturns? And so there's really two sides to it. One is winning from the upside of a downturn, which is our two strategies in our income and acquisitions fund. One is lending in troubled environments where private credit can win, and one is in acquiring when it's the best buying opportunity in small balance commercial real estate in my life. And so you can win from the downside. And it's not, I mean, buying right or lending in high interest rates, it's not complex to understand. Or you can the strategy really is allocating into a diversified portfolio, not in just real estate, or not in just oil and gas, not in just stock market or a stock market portfolio, but in some of these lesser known asset classes, a bit more novel, lesser known to accredited investors, right? Our normal hardworking professionals, but very well known to larger hedge funds, private equity, endowments, ones that are looking for true resilience. And these are not hard to find necessarily. They're pretty typical industries. These are medical, for example, is an industry that you constantly need healthcare regardless of what's going on. Education. The legal industry, if you take a look at the legal industry, just steady, tried and true growth. I mean, you guys live it. And there's, although I haven't seen the data that suggests it's counter-cyclical, that people actually get more litigious in tougher times. But the data shows very clearly that it has just a steady growth to the legal industry. Whereas if you look at any of our charts, you're going to see that the stock market went for a wild ride over the last couple of years, couple decades. This gold did, oil and gas did, real estate did, most certainly. But legal, medical, plumbers, CPA firms, they just simply didn't care. They just simply don't care about those market fundamentals which drive those markets. And so that's where we stepped in and said, look, we should potentially get some exposure to the legal industry through litigation finance. And that as a way to be a part of a solution to a need in the legal industry, and also participate in the fundamentals that are resilient to the rest of the portfolio that we have. And so that's that true non-correlation, that true resilience into assets which don't trend, rise, and fall together.
Well, I think we should focus on that litigation finance, if that's okay, because I was curious about it, and I think that this is something that investors may have some resistance to, and just roll their eyes and think, oh, I'm just why would I ever invest in making all these lawyers rich and investing in the just helping people fight, but it's more to it than that, and I bet you could tell a story about why the litigation finance really can be helpful in instances where people might not have other options.
It can be just like any investment. It can be highly risky, or it can be early on and speculative, or it can be later stage and very calculated and low risk. It can be harmful if it's done in a predatory way, or helpful if it's done in a way that serves and solves needs, right? And so you gotta navigate. Are we going to be the oil and gas wildcatters, right? The speculators, the angel seed funders, and gamble big and try and make it big, or be very late staged in cases in which there are thousands of harmed individuals due to some evil Goliath, right? That is sitting there dominating. And these are somewhat individuals that have been harmed, aren't able to help themselves. They can't afford the amount of funds required to get justice. And that's unfortunate. Why? Because in America, we don't allow bullies to steamroll. We have a system where if somebody's harmed, and so there's a harm, or there's a tort that occurred, right? And there's a mass harm, a mass tort, lots of people similarly harmed or wrong or injustice, they can seek justice through the courts, which is litigation. It's just a simple process, right? But it's expensive. And so kind of look back in our history, like the first real example of a third party stepping in the United States. Now, litigation finance or legal funding goes back to the dark ages when lords of lands were preventing the border peasants, they were funding the border peasants in their disputes to keep their sovereign, soil. But in more modern day, you look at the first big case in the United States was actually in 1910. And it was when, all these people were smoking these cigarettes, and they're like, you know what? I don't know if these are healthy for us. I think we're all dying horrific deaths. Like, this is not, I think they could be lying to us, but how are we going to afford these people who are going to, with all the intimidation out there, these scientists and these doctors and these attorneys to step out and risk huge amounts of their reputations and funds to represent all these people who are harmed but don't have the finances, right? And so it was in fact in 1910 that they did go up against American Tobacco, and they prevailed. And now we saw huge social change as a result. So there's lots of modern day examples of that, which we're participating in, some of which are Roundup, right? Bayer, Monsanto said this stuff was safe. They lobbied and submitted EPA reports, which have been retracted. And now there's horrific illnesses for the people that look after our land and our crops, right? The farmers and the landscapers. And there's 3M firefighter foam. There's PFAS chemicals that are contaminating our water, harming our military and civilians. There's baby formulas, NEC baby formula, that has caused horrific illnesses. And that's another case that we're involved in. Suboxone, it's another case we're involved in. It's and then we're also involved in some cases in which there were organizations put in charge to look after people. These are organizations such as hospitals or prisons, juvenile detention centers, one of which we're involved in LA County, and just announced a huge settlement because there was a sexual assault that had been ongoing. In a lot of these cases, you don't have to put those harmed people on the stand. They don't have to tell their story. They just have to come up and say, look, I was harmed too. And then through discovery, you find out they knew about these complaints, but they didn't do anything. They didn't report it, and they didn't do what was necessary to fix it, right? And so there's lots of these cases out there where these attorneys, they want to help. They're working on a contingency fee basis, not pro bono, but contingency means they're taking on the case for free, and they're going to take a percentage of the settlement on the backside. But where's that going to come from? Tens of thousands of people. They need this help. It comes from third parties, right?
Yeah.
And they come to people like us.
Yeah.
Yeah, and there are no guarantees. I mean, it's a success-based deal for those attorneys, and they wind up. I mean, I've talked to some of my friends that done the plaintiff side work, and just it's extraordinary the amount of money that these contingency fee guys can invest of their own funds, and that's the only place it comes from, unless they've got somebody like you.
Yeah, and I think the way you structure it, just to add to I should say, to add to the process or the system, or it's systematic. You have a structured approach to your litigation fund, and I think I read about it, but also I'm just familiar with the structure from other contexts. And there are different kinds of insurance products that you can get involved, and there's a way to mitigate risks of being a zero-sum game in the end, as I understand it.
Yeah, so like I said, that I can't speak to other litigation funds because there are some out there making really big bets on single event cases that are super early on and are touting angel investor kind of returns, like 30x return. And that is not our jam. I bet big before on speculative development, lost my ass. Not what we're doing. We're typically in very well, what we call causality and liability is established. There's other settlements like these cases that have happened nearby. We can underwrite the value of individual claimants, individual harmed individuals, and we can lend on a loan to value that is conservative, 10, 20, 30%. And on the contingency fee base, where we know we can give meaningful settlements to those claimants. This isn't class action where maybe they got $40, $50, $80, so it doesn't change anybody's lives. These are cases in the small end, they're 50,000, usually 100, 200, 400,000 that these individuals are going to realize. So it's in its later stage to the point where these attorneys have a lot of skin in the game. Just like our lending fund, when we're lending into real estate, we're looking for an asset that can be valued. Valuation specialists that can value a docket of an attorney's clients. Very similar, we can value a real estate deal because there's appraisals, right? It's an asset you can get a lien on. We can get a lien on. We can get a credit agreement and a lien, UCC1 filing against the attorney's assets, the corporate assets, just like you can get a deed of trust and a lien on real property. And you want somebody that, as you said, Ronald, they have a lot of skin in the game. they have time, they have energy, they have finances or resources. And so you want to find people that are invested, and you don't want to be speculative. You want to be later on.
Yeah.
And while 90% of civil cases tend to settle anyways, right? It is the case that we find ourselves in cases which are very near settling. And we try and be involved in cases where we're not going to get 2, 3, 4 huge upside. We're going to get much more reasonable and smaller upside, maybe, 10, 20% returns yearly, versus 30x returns. And in exchange, we get less downside risk.
Mm-hmm. Just to comment, something I love about talking to people that are involved in this alternative asset space is it gives room for people to be a little bit mission driven in whatever way that means to you. And so I just really appreciate that aspect of things. And it's something that you're absolutely like 100% spot on with these different kinds of cases that are out there that are kind of just, I don't want to say mundane, but they're very important to the individuals involved and probably to us as a society as well. And there's also, of course, legal precedent that gets set through these kinds of cases if they make it through to a final determination by a judge. And yet, it's also a way to they're part of the economy at the same time. They need money, and there's a way for people to make money in a balanced way, is what I hear you saying. And I find all of that very positive and very indicative of the entrepreneurial nature of our American culture. Because there's also a community aspect to it too. It's people pulling together to help people too. And I think in this alternative investing space, even in the real estate space, there's often sort of underlying mission-driven factors like that do have a community orientation, about kind of wanting to help people out a little bit. And I really appreciate that personally. So thanks for sharing that part of things, Patrick.
We've done a lot of mastery series, and we've covered kind of topics around this, purpose and profit. And, first we most certainly are providing risk adjusted returns to our investors. But anyway, in our real estate deals, we talk about at the same time, let's make sure we're providing a cleaner, safer, and improved living experience for our residents. Right. Mm-hmm. And while these tenants of these buildings, which is the underlying service we're providing, are paying steady Eddie rents because they can afford it, why not also help people who can't afford it, who can't afford their defense, who can't afford to get access to justice, right? Why not help these attorneys afford their rent? Help these attorneys afford the ability to provide access to justice to those who otherwise couldn't afford it, right? And so both sides of those have underlying great fundamentals, as you said, for the community. But at the same time, they provide incredible non-correlated risk-adjusted returns.
Exactly. It's cool how everything is integrated. Roland, do you have a...
Yeah, well, I thought I was just looking at the time, and let's move on to talk about the real estate as well. And one question I have is, with all our real estate clients that have success, they always have this story that we look at many, many more properties than we actually ever make offers on for acquisition. So, you have to kiss a lot of frogs before you find the prince. So that would be interesting for me personally, just hearing about your process and how you identify good investment opportunities.
Yeah, it's really interesting. So in our acquisitions fund, where we're acquiring real estate, specifically, our focus has been on small balance commercial. It's a little bit underserved right now at a time when the industry's just been pummeled for all the reasons I stated earlier. And you find a lot of performing properties, but either bridge loans coming due, they've just been strained through COVID, or they have other assets they just need to exit. Other performing properties with financially distressed ownership. And so we have looked at recession resilient, advantageous markets around the country. We look at the nature of the performance of the assets, and then we build a diversified portfolio of commercial, not office. So I think office is a bit of a falling hot knife. I'm still not quite sure how I can't quite get into office, but we're talking residential. We're seeing a lot of manufacturing, industrial warehousing, especially through COVID, and now through the tariff battle, we're seeing a lot of that resurgence here, and especially in some markets and some retail strip centers. Really fascinating, the price point you can get them at, incredible cash flow, great value. And so what we've been not very big on is underwriting the way we used to underwrite, which is let's look 3, 5, 10 years down the line. Let's buy something, inject a huge amount of CapEx, and then hope that those improvements translate to higher rents, and hope those higher rents translate through a cap rate to a higher value, and hope that we still have a stable market on the back end. And what's brilliant about where we're at today is you don't have to do that. There's enough out there to buy right and make that return on the buy, just like in 2009 and 10 when people were buying retail residential single family homes for pennies on the dollar. Right now, it's not quite pennies on the dollar, but we can get incredible deals on commercial assets that are opportunistic. And as you say, Roland, about 15,000 at the top of the hopper. And we have dozens of LOIs going out every couple of days, and then we usually have 2 or 3 signed LOIs at any given time, and maybe we're doing one property every month or two, right? So there's a huge funnel. You got to kiss a lot of frogs, but we're really looking for those opportunities where we can make that return going in, and we don't have to make a bet on the economy long term or on the market long term or on the asset long term. We can get in, we can get out quickly. We've actually been underwriting to a 14-month hold with these assets, which is like, how could you do that? Well, if you buy it right, it doesn't matter how long you held it. And we've moved quickly to purchase it, mostly in cash. So we tend to beat out their higher offers because, those other people, they're trying to get financing at a time when it's very difficult to do that. And they're not quite as strong as us, and they can't move as quick. And so it's kind of through some of those methods that we've been more competitive.
So Sarah, just to note real quick that, so many of our commercial real estate clients use debt extensively. And what Patrick, just to note, put a pin in what Patrick just said, that they're primarily, cash. And I was looking through the properties, the examples that you have on your website. And again, compliments to your website. It's real clear just looking at all the different acquisitions that you've done. But for sure, you're saying that you're buying this with very little debt, which really does protect you. And if you buy it right, then you can maybe have greater flexibility in terms of when to sell.
Yeah. It was just Patrick, we were speaking with someone else last week, and he recommended an article that was written by Warren Buffett in the early 1980s. I just finally had a chance to read it. And he's talking, of course, about value investing and why would you, if you had the chance to buy dollars for 40 cents, do you see that as a value proposition or not? And the people who see that immediately become value investors. Sounds to me that you've kind of struck on the commercial real estate aspect of that, which is you're finding these deals that as soon as you buy them, they have a value in them. And also if you're not leveraged and you can do the cash purchase, then you probably can get even better deals and faster, just like you're saying. So it strikes me that, it's an ideal place to be. I think when you can buy real estate with cash, it's a whole different thing.
Yeah, and we'll use leverage on the back end, right, to kind of refi out, but that doesn't help. That doesn't prevent us from moving quickly and pouncing, and that is really on the acquisition side, right? We have a whole different approach for debt, and our pool and our income fund, which we set both these up, the income and the acquisitions fund, as opportunistic funds. They're sister funds, essentially. And it's how you win from the upside of the downturn in both debt and equity as being the senior secured position as well. Not rescue capital, not preferred equity, not second mezz debt, but senior secured. In a high interest rate environment when banks are on the sidelines, right? How do you win from that? And just like in 2010 and 11, we saw a huge resurgence of private credit. We're seeing that right now on the commercial side, huge resurgence of private credit, which allows us to, at a time when you used to only get 6, 7, 8% on these assets, now we can get 12, 13, 14 because they know our lending arm, is reliable. They trust us and we move quickly. Rapid lending, and rapid lending is our name. And so we're able to step up to the plate and be a solution that allows these people to actually close on these assets quickly, instead of getting jerked around for 30, 60, 90, 120 days, where these lenders are feigning, hey, I'll still give you an 8 or 9% interest loan. That just never happens. They constantly retraded the loan to value and they don't actually ever close. I'm experiencing this on our holdings. So the ability to get that sort of steady Eddie, cash flow from a low loan to value debt fund. I think we're at 80 or 58% loan to value in our debt fund. So a lot of insulation from market volatility and get some steady Eddie cash flow from that. Or growth, right? Buying right. You said, buying assets, buying dollars for 40, 50, 60, 70% cents. I resonate with that right now because this is one of those very unique times in my lifetime where you can do stuff like that. It's incredible.
It's really cool how you've got these three things integrated. Well, I guess you have your two commercial real estate funds integrated to cover off different aspects of it. So it sounds like you kind of can also generate some efficiencies when you're out there looking for deals. Then you can, they might get steered towards debt. They might get steered towards acquisition. So you get some efficiencies just from your team, not having to just say, oh, we don't look at that kind of a deal. You kind of look at everything maybe, and then you can, if it's a hard pass, it's really from different aspects of it. It's really interesting. And then, of course, the litigation funding being completely non-correlated.
Well, we're coming up on 30 minutes. Want to be respectful of everybody's time, for sure yours, Patrick, and our audience, but maybe thinking about where we go next. Is there anything that we haven't covered that's really an important aspect of your business that we want to make sure we get a chance to talk about?
Well, so we have a platform called Passive Investing Mastery where I was, like many of your listeners, a high paid professional out there struggling to climb the corporate ladder, putting tons of hours in. And I was loving it. I miss it to some degree, automation, robotics, but, I didn't know. I didn't know that there was more than just the 401k, the IRA, the startup, the Bitcoin, the stock portfolio. And I was working in Facebook and Google and Lockheed and Raytheon and Boeing and Johnson & Johnson and Abbott. And I was doing projects, some of the smartest people in the world. I just was blown away. And there really was no education on what alternatives are and how they fit into a well-balanced portfolio. And I certainly wasn't born into that education either. And so what we're doing with Passive Investing Mastery is we're providing that. So bi-weekly, we host an educational webinar series. It's called Alternative Investing Mastery Series. And we seek to help investors achieve mastery in the art of alternative investing through exposing you to all the different kinds that are out there. And was for decades that I was just with a couple other dudes trading the baseball cards of alternative investment strategies. Like nobody was talking about it. And so we started presenting those like, hey, here's my hand, and then I started saying, well, here's the deck, right? Here's all the other ones out there. And we've had everything from laundry mats to gold mining, right? To Forex trading, to just parking lots, to wine barrel, right? Alcohol, bev, cask investing. We've had just all kinds of alternatives and the pros and cons. We had buying a plane for cash flow, investing in pilot education because there's a huge disparity. We need huge need for pilots out there. Just an endless number of different strategies. We've had affordable housing, all the different versions of that. And then we bring on strategists, asset protection, ones on retirement accounts. And so we basically providing this bi-weekly series and highly recommend everybody get in there because nobody can really, the human condition isn't that we can all go wander out into the desert ourselves. We're not like that. We're nomads, travel together, right? And so, I recommend you get into groups and you get onto series like ours where you start seeing other strategies that become more familiar, more similar to you. And just like how I made literally identical parallels between an asset-backed lending in real estate versus an asset-backed lending in legal industry. And they're almost identical parallels. You're going to see those same parallels in other kinds of alternatives that will help to build your confidence level. And then you'll be able to start making steps towards building true resiliency, pillars of investments that don't ride the same waves. Don't ride the same market fundamentals, and you'll sleep a little bit better. And I usually tell investors, like, hey, go home tonight, build a pie chart. Because in our decks, we always have this pie chart of like, here's the middle class, here's the high income, and here's like the ultra wealthy. Like, here's where their allocations are. Where's yours? And then we show Tiger 21s. Like, do your pie chart of like, okay, you got this amount in this industry, this, and then just kind of imagine, how do you feel today about each of those slices, right? Are you very high in the stock market? Are you high in real estate? Are you wherever you're at? How would you feel if you added another slice and maybe borrowed from here, borrowed from there, and, figured out how to fund it? Maybe you added another slice to an industry that's completely non-correlated, that won't be affected. Would that make you sleep better at night? And is that future self, that one that's not staring at the TV, worried about the stock market, looking at their phone ticker, is that future self going to be better off? Is it worth the time and energy right now to learn and educate yourself about these alternatives? Because it certainly was for me. As I started stepping into other lesser known alternatives, started feeling better and less worried about what happens in my greater portfolio.
Well, let's. I'll reach out to your assistant to make sure that we get the exact details of links that you want to put down below, Patrick, because I do think it sounds like it's a great opportunity to learn more with you. I'm going to certainly look into that myself. And otherwise, just to finish up, I always like to ask this question, which is, I think people who operate in this space with alternative investments tend to be entrepreneurial and also are like balancing a lot of plates. So there's a personal aspect, which is, how do you manage it? Do you have like a secret process, or your family has a certain saying or a motto or anything that kind of keeps you going personally as you are, living this life where you're sleeping better because you're invested in non-correlated assets?
It's an interesting one. I've been on over 100 podcasts, and I don't think somebody's quite asked me, do we have a motto or a secret process?
The reason I ask you is that people do, actually, when you do ask people, we have somebody who's got a family motto. It was, do you remember it, Roland?
Well, I don't remember the motto, but they just, every year they have kind of a review.
Okay.
Like as a family.
How, like a reflection and evaluation and maybe goal setting. And, I don't know if it's just the motto.
No, the motto was work-life harmony. We seek, as a family, we seek work-life harmony.
Yeah.
So perhaps motto isn't a great descriptor, but it's...
No, that is. I forgot
phrase.
about that. Yeah.
Yeah.
But,
so I can't think of a motto off front. There's a couple quotes that, I like to throw out there. I'm not sure if it was Winston Churchill or Napoleon. No war ever went to plan, but I've never won a war that I didn't plan thoroughly. And there's some times that have been tough, and I think it was Winston Churchill say, if you ever find yourself traveling through hell, keep going. Yeah. So don't stop. Let's just plow through it, right? Let's make it happen. In our company, I have the benefit now of being able to do projects with people that I want to work with, which is excellent. So we work to create the best environment. We implemented EOS, which has been an excellent tool for us to help build, quarterly rocks and goals and get that, accountability and responsibility down, to the individuals all, and actually, creating our goals together and so as an organization, which has been a lot of fun. And, I think we strive, my wife and I, we're in Hawaii now. And I think it's through these calculated steps into a little bit of an uncertain future that we were able to create the time freedom and location freedom that we have now. And I have a 2.5-year-old. And so, I'm able to attend the soccer matches here. They call it KK Kicks. That's their word for kids. So I'm going to take them swim lessons and go to the beach every day.
Wow.
It's only about 8 minutes from here. So those were not things that I would have otherwise had been able. So our goal really has been, to create a life that, is our best life, and to then give back in a way in which we can show others how to make steps towards that same freedom.
Yeah, that's really cool. I just wanted to also mention, we didn't get into it, but you also have written books, and we'll put references to all of those down in the show notes so that our audience can get to know Patrick really fully. So thank you so much for spending the time with us today. It's been really wonderful to hear about everything you've had to say. So
if anybody wants to have a chat, passiveinvestingmastery.com. My calendar's on the homepage. It's one of the things I love to do is invest in other people wherever you're at. If I'm on a stop along the journey, that's excellent. I can get you pointed. We've interviewed like 40 different alt assets. Very likely to find one to point you in if it's not one of our own. And if I would be happy to offer a free copy of one of the books I contributed towards if you'd like, Sarah.
Oh, wow. Thank you. That would be wonderful.
Just mention altinvestingmadeeasy.com. It's a special deal we've got, right? Just joking.
No, it is. Yeah. So it's passiveinvestingmastery.com/book, right? That's the secret link. And then if you put in the name of the podcast, I will, in fact, I sign and then we ship them out for free. We can download the ebook if you want, or you can download the ebook and get a hard copy.
Oh, wow. Cool.
And, yeah.
Thank you. I will definitely do that. So
yeah, that's a great deal.
You're not going to get it. Now, I mean, it was a really cool, project. I did it with, a couple dozen other guys. One of them was a lead guitarist of Def Leppard, and he did a chapter, an actual rock star. There was a Navy SEAL, NFL, NBA players. It was an amazing book. It's called Lessons from Thought Leaders. I tell my whole journey, losing it all, and in my first real estate deal, making it through high tech, and my single families, and then apartments, and energy, and oil and gas, and lesser known alts. And I tell my whole journey, and hopefully, if it inspires some other people along their journey, then it's enough for me. So be happy to share that with you.
Thank you.
That sounds great.
Thank you.
Well, I think that's a good place for us to wrap up, Sarah. What do you think?
Yeah, I think so. So thank you, Patrick. And to everyone out there, thanks for joining us today on Alt Investing Made Easy. Please like and subscribe.
And remember, everyone, take aim with your alternative investing strategies.
See you next time.